you could argue right now that inflation is far, far higher than we are being led to believe. It's kind of like the CPI is a funhouse mirror, right? It distorts what you're really looking at. It excludes food and energy and housing. You ask John Williams of Shadow Stats, he'll say add an 8 in front of the number. And that's what it really is. You're talking about 11%, not 3%. Your rent has gone up 20%. Your grocery bill is nearly doubled. Your insurance bill is down here in Florida is through the roof. So the CPI from the Bureau of Labor Statistics, you could remove the L and call it the CPI from the BS, is something that I take exception with to begin with. So maybe it just actually has them be slightly more truthful. To me, the issue with the new Fed chair is, what are their policies? And one of the people that I've interviewed myself was Judy Shelton, who was his nominee in 2016 to run the Fed. And many people think she's on that short list of those that would be head of the Federal Reserve. She is someone who advocates for issuing a Treasury bond, 50-year in maturity to begin with, denominated backed by and deliverable in gold. She's told me, by the way, in no uncertain terms, that Trump has told her that on July 4th of next year, 2026, which would be the 250th year anniversary of the country, that he would issue these Treasury bonds pegged to gold. Someone like Judy, who is a Austrian economist at heart, who understands sound money, who understands the principles of gold, understands that our Treasury market has been weaponized and has lost appeal globally. This Western-based rule system that has really benefited the West is something that much of the world is pushing back against. And that's why since 2014, Gary, net, there's been no new central bank buying of treasuries. Now, there's been plenty of central bank buying, but not any new central bank buying. And now we have countries like China who are selling treasuries in favor of gold, which has outperformed the treasury for 25 years. Gold has outperformed by 2-to-1 the 10-year treasury since 2000. It was up 40% last year against 4% of the treasury. It's up 35% this year. It continues to beat the performance of the Treasury, but it has no counterparty liability, no counterparty risk, and one could argue very much the same liquidity at those levels. And so this is a trend that we see happening. And to Judy's point, why would anyone want to take our treasuries in a world where austerity is thrown out the window, where the current administration, even with Doge, really can't do much to bring down the debt? In fact, they're raising the deficit this year another $2 trillion and wanting to get rid of the debt ceiling altogether. So the point of it is that I think it matters from a standpoint of who's in the chair. Is it someone that would understand the principles of sound money, or will it be more of the same of debt monetization and manipulated interest rates and all of the frolicking, if you will, or the shenanigans on a monetary basis, or let's just call it brain dead monetary policy, that has got us into this pickle to begin with. So let's just cross our fingers and hope it's someone with a true understanding of sound money, of Austrian economics and libertarian viewpoints as it pertains to a more free market system, if that's even possible at that level. Interest rates, first of all, should not be controlled by the Federal Reserve. They should be controlled by the market, first and foremost. The problems of allowing the Federal Reserve to create it or to control interest rates is what has gotten us into the problem that we have. But what it really does is, and it would accelerate inflation, in my opinion. Why would that be? Well, when money is created through lending. So when there is money created through lending, or let me put it to you this way, when the Federal Reserve comes in and buys the treasuries, this is an easier way to understand, from these banks who hold them, they are obligated to sell the treasuries to the Federal Reserve. And the money that they get, they have two things they can do with it. The same thing is true when they create loans. I mean, there's two things they can do with the money. One is they can lend it out to the system, to you and to I, a home equity loan, a car payment, a mortgage, a credit card, whatever. Or they can give it to the Federal Reserve at a higher rate than, arguably, to Senator Kennedy's point, than they should be receiving, which in essence takes that money out of the system. It's almost deflationary. The bonds leave the system. The money goes back into a reserve account held at the Federal Reserve, because their thought process, I would guess, is, well, I'd rather give it to the Federal Reserve with no risk, earning a nice rate of return, than give it to Gary to take out a home equity loan, or to Andy to take out a car payment, or whatever it may be, because of the risk that is involved. It's a riskless proposition. And in essence, what is happening is that all of that money, which is now a liability to the Federal Reserve, is eating away at their profitability. And one thing that a lot of people don't understand is that if the Federal Reserve is profitable in any given year, that portion of profit goes back to the Treasury general account. Well, they are wickedly negative right now, and this is part of the reason that they're paying a higher rate than they can otherwise achieve elsewhere. And so they're negative equity year over year now, last couple of years with the Federal Reserve. And so I think that it actually isn't a bad idea at all. And I, for one, without knowing the greater ramifications on a macro scale, just off the top of my head, would say it's probably something that would be good for the economy. Get the velocity of money moving again. And it could be inflationary, but what it would do is free up liquidity, and they would be more apt to lend money and to keep the game going than to not. And when you talk about things getting tougher in the economy, we will see a credit contraction. These banks will do all they can to not lend the money out into the system, and the best place to put it for them now is the Fed, earning this fat return, no risk, and a handsome return. I can understand why they would do it, but you take that option out, and I think it could have some interesting impacts all the way around on the economy. And all of those things you would think would be very good for certainly for a precious metals company. I mean, you can't make it up. But one of the things that I would point to when we talk about the market, which is more pressing than any of it, and I think everything that you just said is a function of information, right? And how many people on Main Street really know all of these things or think about it? And you think about the research that you need to do and that I need to do to answer that question, but just the amount of research you need to do to ask that question and to understand what you're asking means you're putting far more effort into understanding what's happening in the world than most people do ever. And the media that we have, where last week during the riots, ABC News gentleman, in fact, I even wrote it down because, and I'm going to get to your question, but I couldn't believe that he even said something so silly. But anyways, the guy that for ABC News basically was saying that, if a military presence in California and Los Angeles, it could spark violence, because all you had was a group of people just having fun watching cars burn. And he was serious when he said it. I mean, I'm thinking, yeah, that's what I do for fun. I go down to the city with a bunch of my crazy friends and we light cars on fire. It's just fun. But the point of it is that the information that is given by the media seems to be so divisive at heart and not informing people what is important. So all of the stuff that you just said is about information. I get it. So let's take a look at what's really happening from the standpoint, looking at it from who's got the information. Since the beginning of 2025, institutional investors, now these are people by their very nature that have more money than most, but they also probably have more information accessible to them than most. They have whole teams of people that are researching. And at the level that we're talking at hedge funds and pension funds and very large, sophisticated endowments and whatnot, they're all close to the information as well. Not just the information you can pay for and read and subscribe to and study, but the information by the policymakers. Since the beginning of the year, institutional investors have been selling U.S. stocks literally just about every single week. Professional investors sold $4.2 billion in U.S. equities the first week of June, and their 4-week average since then has been over $2 billion per week. They continue to dump stocks. Now, at the same time, private investors have never held more U.S. stocks. U.S. households, mutual funds, etc., their financial allocation to stocks is at a record 53%. This is even larger than the dot-com bubble, which was 51%. So at the same time, cash allocation is at an all-time low in people's accounts. So what you have is the insiders moving away and selling and de-risking. Look, think of Warren Buffett with $500 billion on the sideline, and you have the institutional, the retail mom and pop all in. What could possibly go wrong? So I would say when you add in all of the things that you just said, to me, it's not about return on your money right now. It's about return of your money. And in an environment that is as charged geopolitically, politically, morally, socially, as divisive as it is, with stocks trading at all-time highs nearly in terms of multiples and PE ratios and lack of dividend yield and all of these things, not to mention what's going on in this country, the charge in the air, the divisiveness, I think now more than ever, it should be the opposite of what we are seeing. And isn't it interesting, whether we're talking equities, where the insiders are out and the retail is in, or metals, where the retail is really not participating, but yet you're seeing record deliveries that no one's ever seen before, becoming a net importer of gold since November. In this country, the largest deliveries in the history of the COMEX market in both gold and silver occurred on the May contract. And every single month it's like this, and huge offtakes. And in order to do that, not only do you need to be wealthy as hell, you need to be as sophisticated as hell. You're talking the most well-funded and well-informed traders in this country are standing for delivery and draining the exchanges in London, on COMEX, and around the globe. At the same time, the public is fully into the risk-on trade, but the institutional traders on that sector, well, they're on the sidelines. So I ask you, what could possibly go wrong?